Chapter 12 will be discussing compensation. Specifically, we're going to discuss and explain the tax implications of compensation in the form of salary and wages from the employees' and employers' perspectives. We're not going to do Learning Objective 2, but we will be doing Learning Objective 3, compare and contrast taxable and non-taxable fringe benefits that were introduced in Chapter 5, and explain the employee and employer tax consequences associated with those fringe benefits. So we're going to go through all of them again in detail. So let's start off with salaries and wages. Employee considerations for salary and wages are the fixed amount of compensation for the current year, no matter how many hours are worked. Salaried employees eligible for bonuses, so bonuses are included. Employees receiving wages generally get paid by the hour. Salary, bonus, and wages are all taxed as ordinary income, and they are reported on line 7 of the 1040. Generally, it's the cash you receive during the year, unless you could have constructively received it and you chose not to. That's what will be included in your salaries and wages. Employees complete a Form W-4 when they are first hired to supply the information to the firm so that they can withhold the correct amount of federal income tax. So on this W-4 form, it indicates whether to withhold at a W-2 summarizes an employee's taxable salaries and wages. It's given to an employee and also sent to Social Security Administration, a copy of which is provided to the IRS. It provides annual federal and state withholding information. This is what a tax preparer uses to report the wages on the Form W on the 1040 line 7. The Form W-4 again supplies an employee's information. It's generated by the employee and it remains constant unless an employee makes changes. So for instance, I got married in May of 2017. So when I got married, I had the opportunity, I had a life change, to change my W-4 form, and I did at my employer's to reflect I was now married, so I wanted less income tax taken out. So the employer is not controlling how much money you have taken out of your or the taxpayer's paycheck. You are. And you just file a new W-4 when you want that amount changed. On the employer side, so that's the employee side. On the employer side, they get to deduct salary and wages on their tax return that they pay. So employers computing taxable income under the cash method generally deduct salary and wages when they pay them. Those that do the accrual method deduct wages payable as well. Compensation expense that's accrued at the end of the year is deductible in the year accrued. So if you expense it before you pay it, that's an accrual. You can deduct it in the current year even though it's not paid if it's paid to an unrelated party, so an employee, and it's paid within 2.5 months of year end. If it doesn't meet those conditions, it's not going to be deductible. Now, compensation expense can be accrued at the end of year and deductible when it's paid to a related party and that related party owns more than 50% of the employer corporation. So now we're talking about a shareholder. After-tax cost of providing this salary is generally much less than the before tax, as the employer deducts salary and associated FICA taxes paid. So if we're trying to determine what's the after-tax cost of giving someone a salary, well, remember, for purposes of federal taxes, when we give someone a salary as an employer, we're paying them gross pay. Part of their gross pay goes directly to the employee. Part of it goes to pay taxes and voluntary deductions and things like that. It still costs the employer, though, the gross pay. If you take that and add to it the FICA match, remember, employers have to pay the FICA tax as well. Okay? Those two amounts added together are deductible. So, you take the deductible expenditure, the salary and the FICA, and if you multiply that by 1 minus the tax rate of the employer, the marginal tax rate, so the tax rate for $1 more of income, that much is how much it actually cost the employer to provide that salary. Now think about it. I'm going to do a little computation. You could grab a scratch paper. Assume the deductible expenditure. So what that means is that the employee's salary plus FICA tax. So how much the employer can deduct on their tax return for paying that employee, the deductible expenditure, is $100,000. So the employer gets to deduct on their tax return, even though they paid out $100,000, they get to deduct that on their tax return. So they're going to have a tax savings from that payment. How much? Well, let's say their marginal tax rate is 30%. If you multiply 100,000 times 30%, that's $30,000. So they don't have to pay $30,000 because they have that $100,000 expenditure. So how much is the after-tax cost of really providing that salary? Well, they had to pay out $100,000, but they saved $30,000 on taxes, so subtract it. So the actual cost, the after-tax cost, is the difference, or $70,000. Now, if you use that formula there, they take those two steps I just did and combine them into one. 100,000 times 1 minus the marginal tax rate, 1 minus 30%, will give you 70%. So the actual cost of the salary is only $70,000. So let's take a look at an example. XYZ Inc. paid one of its employees $80,000. They are in the 35% tax bracket. What is the after-tax cost of the salary to XYZ Inc.? Well, the before-tax cost would be the salary. The total cost is $80,000. But because XYZ can deduct the salary as an expense on their tax return, they save in taxes. How much? 35% of $80,000. So the actual after-tax cost would be the $80,000 minus the tax savings, which would be 1 minus 35%, or $52,000. Another way you can calculate this is determine the amount of tax savings on $80,000 by multiplying it by 35%, and that would be $18,000. I'm sorry, $28,000. I did that quick in front of me. I'm terrible at that. Isn't that? I won't admit that. In open court. No, I'm kidding. It's 28,000. Subtract that 28,000 tax savings from, so that's money you're actually getting back. You don't have to pay income tax on from the 80,000. So the actual cost after tax is $52,000. Fringe benefits. Employees, this is what we talked about before in Chapter 5. Employers often provide non-cash benefits to employees in addition to their cash compensation. And they range from all different kind of things, health insurance to the use of corporate aircraft. Normally, they're taxable to the employee on receipt. That's the general rule because Code Section 61 says include everything unless it's specifically included. And right in Code Section, it says compensation for services, including fees, commissions, fringe benefits, and similar items. So we don't look and go, oh, it's a fringe benefit, it's non-taxable. That's not true. Employees recognize compensation income on all benefits received unless specifically excluded. That's what I just said, right? Treat benefits received like taxable compensation, cash compensation. And the employer deducts costs and pays employee share of FICA taxes on benefit. We've talked about that. So what are the employee considerations? Employees may prefer a taxable benefit to an equivalent amount of cash when they benefit from employer-provided quantity or group discounts associated with the benefit. Employees must recognize a certain amount of gross income when employers pay life insurance premiums for the employee for policies with a death benefit in excess of $50,000. This is group term life insurance. A lot of employers offer it, and a life insurance policy on the employee. If your life insurance policy is $50,000 or less, so at death the payment would be $50,000 or less, there's no taxable compensation to the employee. All premiums are tax exempt that the employer pays related to that policy. Sorry. What triggers or makes premiums taxable is when the amount is higher than $50,000. For instance, you have a $70,000 life insurance policy at work. Premiums related to the first $50,000 of it are tax exempt. You don't get taxed on them. Your employer pays them. They deduct them on their tax return. They're not included as income on your tax return. But once your death benefit goes above $50,000, the premiums related to the amount above $50,000 are taxable. And here's how we compute it. We subtract $50,000 from the death benefit. So if it's the $70,000 we just talked about, $70,000 minus 50, and that's $20,000. So the premiums related to $20,000. Divide step 1, the $20,000 by 1,000, we get 20. Multiply the result from step 2 by the cost per $1,000 of protection for 1 month from the table provided in the Treasury regulations based on the age. So we would need that table. Okay, so we would go into the Treasury regulations and find that. And that would give us our monthly cost. Then we multiply that by 12, and that's how much of the premium would be included in the employee's income. And normally the employer adds it in on the W-2, but it is taxable, and we want to be aware of that. So there is the table. Oh God, it's here. So if you are between 35 and 39, you would take 20 times 0.09. That's $1.80 times 12. So it's not a huge dollar amount, but it is taxable. $1.80 times 12. I'm doing it old school here, so I'm hoping I'm doing it right. So, taxable would be $21.60, but it is taxed. Okay. The employer consideration, they treat taxable fringe benefits just like cash compensation. So when there's any fringe benefits, they're normally allowed to deduct them on the tax return. So it deducts its cost of the benefit, not the value. So whatever they're paying for the benefit. That's what that slide's talking about. We're not too concerned about that. We're more about the employee side. So, fringe benefits that are non-taxable are specifically identified in the code. Employee excludes these benefits from their income. Remember, everything is taxable unless specifically excluded. What's even nicer is the employer still gets to deduct the cost of paying that benefit. So, employee doesn't have to show it as a taxable item. Employer still gets a tax deduction for it. Now, there's some specific ones we're going to look at. The first is group term life insurance. So when an employer offers their employees a life insurance policy on the term, a certain term, and it's usually their employment time, they will get a non-taxable benefit to a certain extent. We talked about that. Some of it may be taxable. Another, health and accident insurance and benefits. So the portion of this fringe benefit, health insurance, dental, eye, that your employer pays for, is non-taxable to the employee and is tax deductible by the employer. And any benefits received from utilizing that insurance policy, non-taxable to the employee. Meals or lodging for the convenience of the employer. Now, these meals must be provided on the employer's premise to the employee and are provided for the convenience of the employer. And employers are only allowed to deduct 50% of the cost of those meals. So they're non-taxable to the employee, but only 50% of them are tax deductible. So there's a great example on page 12-26. Assume Julie purchased 25 meals at a cost of $500 on evenings when she worked late. Julie turned in expense reports and receipts for the meals totaling $500, which PPC reimbursed. What is the amount Julie must include in income? Well, she will not include the value of any of the overtime meals because they were provided for PCC's convenience. The other is for lodging. Now, lodging is more strict. It must be a requirement of employment. So the value of lodging for the convenience of the employer and must be required as a part of employment is non-taxable to the employee, fully deductible by the employer. These are very strict examples. Something like a forest ranger must live in the lodge at the state park because it's required as part of their employment. Employee educational assistance. That's also tax deductible by the company and non-taxable to the employee up to $5,250 of that assistance for continuing your education. Dependent care benefits. Dependent care benefits, employees can exclude up to $5,000 of these benefits paid for children under 13. So if an employer provides assistance to employees for daycare services, these are not only tax deductible by the employer, but non-taxable to the employee, up to $5,000. No additional cost services are employee benefits given to an employee in the industry in which they work, where there's no additional cost to the employer to provide this extra benefit. For example, when you see an airline employee flying on the airplane next to you, they are receiving a tax-free, no additional cost service. As long as they work in the airline industry, they did not take the seat of a paying customer. Okay, and there's no additional cost to the employer. It's not a special air flight just for that employee. They just took an empty seat. The key here is that the employee must work in that industry. Now, if your employer owns hotels and airlines, and you work in the hotel industry, you can get free airline and hotel. It's just the airline portion would be taxable. That's a taxable benefit. The employee portion you receive for free would be non-taxable, assuming those other requirements are met. Qualified employee discounts. On page 12-27, they discuss these. Usually up to 20% is tax-free if you're in the service business. If you are in a business where it's a product, you cannot receive a discount of more than the cost. So you have to pay at least the cost of the product in order for it to be tax-free. If you have a deeper discount, so if you're not even paying the cost of the product to buy it, the difference between the cost and the amount you paid would be a taxable benefit. So you want to take a look at that information, and some great examples there on page 12-28. Working condition fringe benefits, it's just a normal items that are needed for business and your employer pays for them on your behalf are non-taxable. Things like your CPA dues, your CPA license renewal, your publications needed, or library public subscriptions to do your job. These are all non-taxable benefits. De minimis, these are so small it's not worth keeping track of. Things like the ham you get at Christmas time, the occasional tickets to theater events, using the copier for personal reasons. It's not worth tracking. Just consider this as a freebie. Your employer was nice enough to do it for you, and it's non-taxable. Qualified transportation fringe benefits. We got to be careful here because of the year, but in 2018, if you have a mass transit pass, your employer provides an employee with a mass transit pass up to $260 a month, or up to $260 a month for parking. These are non-taxable to the employee and deductible by the employer. Amounts above this would be taxable. Now, cafeteria plans and flexible spending accounts are two ways that employers provide benefits. So under a cafeteria plan, employers would look at all the cost of benefits they are willing to provide for their employees. And then employees can pick and choose the benefits that they want. And they could receive cash in lieu of the benefits. Now, the cash is taxable. It's not considered an employee benefit, okay? But any other benefit under this type of plan, as long as they meet the criteria of being non-taxable, would not be taxed to the employee. Flexible spending accounts allow employees to put aside a portion of their money for either health and or dependent care benefits. And then, so they're pre-tax. Before tax, you're never taxed on that money. You can put the money aside, and then when you need to spend it for medical or daycare, you can, and it's not taxed ever. It's just you putting money aside as the employee, not taxed on it, and using it to pay for these types of benefits. Okay, so that is fringe benefits. So group term life insurance. We've talked about this already. Let's go through it one more time. Employer paid premiums are non-taxable up to the first $50,000 of group term life insurance. Any premiums related to amount of coverage above $50,000 will be included in the employee's income in that year. Health benefits, and they give us the code section there. Code section 105 to 106 is where they define the non-taxable health benefit. Employer paid premiums on health, medical, dental, and eye insurance, and the benefits provided through these insurance, as long as they meet a medical definition in the tax law, which normally they do, are non-taxable. So the actual payment of the premium by the employer is non-taxable to the employee, and the actual benefit you receive when you go to the doctors, the hospital, things like that, all non-taxable. Meals or lodging for the convenience of the employer. This is code section 119. This is on in chapter 12, a specific section. I'm looking at page 12-25. It may be a little bit different in your book. Well, we've got to make sure we understand this. The value of meals provided at the employer's business premise, not that went out and got takeout, so they're actually making the meals at the premises, for the convenience of the employer, would be non-taxable to the employee. So if it's a nurse working in a hospital and they go downstairs to the cafeteria and have a free lunch, that is what we're talking about here. It's at the employer's place of business, and it's for the convenience of the employer, so she's still on call. Same with a restaurant and a waitress. So it's very specific here. The employer getting pizza takeout so you can continue working is not what we're talking about here. Lodging, even more specific. The lodging must be a requirement of employment, and it's provided by the employer. So a forest ranger who has to stay in a cabin in the woods as part of his job requirement, that's non-taxable. Anything else really? So when we're looking at it, we really got to make sure, is it for the convenience of the employer and a condition of employment? If not, it's a taxable item. So that income related, the value of those lodgings, the values of those meals would be included in the employee's W-2 or on their tax return if it's not on their W-2. Employee educational assistance. This is in code section 127. And it says employers can pay or reimburse employees for tuition, books, and fees up to $5,250 in a year. So that's per year, tax-free. Now, it doesn't mean that they can't reimburse them more. The tax-free portion, $5,250. Dependent care benefits. Employers can pay up to $5,000 in dependent care expenses for an employee. It's very specific. This cost is for providing care for a dependent, so the taxpayer's dependent who is under 13 years old, or a dependent who is disabled. Okay, so but up to $5,000 of employer-provided assistance for dependent care, non-taxable, and that's in code section 129. No additional cost services. This is in code section 132. Benefits that don't cost the employer a lot of money. You use the photocopier once in a while for personal reasons. You fax once in a while. Okay, this is what we're talking about here. Very small amounts, they're not worth tracking, and don't add up to a huge amount. So they're non-taxed. Remember, as we review these fringe benefits, qualified employee discounts, this is the code section you would find them under. They're reduced prices on employers' products within certain limits. And as I said, as an employee, you must pay at least what the employer paid for it in order to have it all be considered tax-free. Working condition, just to review, it's a benefit provided by an employer that would be deductible as an ordinary and necessary business expense if the employee had paid it. So it's required for your employment basically and for you to complete your job. De minimis are so small and infrequent, it's not worth tracking, and they're considered tax-free. Qualified transportation fringe benefits. Remember, you as an employer can provide your employees up to $260 a month of transit passes or qualified parking, tax-free to the employee. And cafeteria plans. And remember, an employee can choose from various non-taxable fringe benefits. These would not be taxed, but if they choose cash instead because they don't need the benefit, that portion would be taxed. So we do tax planning for fringe benefits. Employer proposed to reimburse employee $200 a month for his parking costs. What amount of this reimbursement would be non-taxable qualified transportation fringe benefits? Well, all of it, because then they can exclude it. So when we are looking at fringe benefits packages, we've got to keep these non-taxable and taxable events in mind, and there are publications out there that give total guidance to employers on fringe benefits. Now, if you're sitting there going, well, I'm going to be doing employees' tax returns, you never know. You might be on the employer side trying to decide, is this fringe benefit taxable or not? Both taxable and non-taxable fringe benefits can make up a significant portion of an employee's compensation. These are taxable unless the tax law specifically excludes them. You got to keep that in mind. Taxable fringe benefits usually represent a luxury perk, so it's something above and beyond, while non-taxables are generally excluded for public policy reasons like health care coverage. Okay, so this table in your book is awesome to keep you get that big picture of all these different types. Okay, this was an example from a prior PowerPoint, I believe, and also yeah, there's an example throughout the chapter talking about Julie and what kind of non-taxable benefits she has. So that was the overall answer for her non-taxable and taxable. And you could see the total value of what she's getting and how much her employer is actually paying beyond her salary. So that is a great example to go through in your book and make sure you really grasp what these fringe benefits, taxable and non-taxable, mean. So please post any kind of questions you may have about the compensation chapter to learn.